I'm going to have to defer to Mr. Curry.
Okay.
He's been a market student at Goldman Sachs for a very long time, and I'm a rockhound. So I think we have different areas of expertise, and I suspect that he's a better pundit. I will tell you that the cure for high prices is high prices.
Mm-hmm.
And at these oil prices, while it doesn't do much to deter in the near-term U.S. demand, it obliterates demand in markets that can't afford it.
Yep.
And my suspicion is that the marginal buyer, which is the one who sets the prices, will need to boycott energy. If the price of oil in Reno, if the price of gasoline in Reno goes up, you curse, and then you start your car and drive somewhere. If the price of gasoline in Colombo in Sri Lanka goes up, the taxi driver parks his cab.
Right.
It's a very different response. I mean, pick one, but from an investment theme, you need to pick a big one. You need to pick a big one because you could look at something like titanium or vanadium, and you have one big new deposit that comes on, and it cracks the market.
Mm-hmm.
We found that. You make a lot of money if you're on the right side of a commodity boom around a small commodity, and then you get your ass kicked if the market and technology works and supply suddenly increases.
Mm-hmm.
So to play the game successfully, you need big markets. You need markets, you need energy markets or copper markets. The truth is, if the AI circumstance that you describe and the demographics that we believe occur over the next 20 years occurs, copper, which is a great big market, will do extraordinarily well. There's nothing we can do to alter copper supply in a reasonable time frame. We can alter price by having a depression, and listeners of yours who are afraid of a depression should avoid, until a depression occurs, the copper market. But to the extent that there are people who believe that we'll muddle through, with or without AI, but particularly with AI, that's a no-brainer. In a lot of discussions, Adam, I think has to be uranium. It isn't merely that AI will require prodigious amounts of uninterruptible power, which is to say not wind or solar, but rather 24/7 power. Uranium does that. And the AI elite also requires non-carbon generating power, which uranium offers. On top of that, the unsung beneficiary of the conflict in the Straits of Hormuz is truly uranium. You will recall, Adam, maybe, you're not as old as I, but you're a student of history.
I got some gray, don't worry.
You will recall, or you may recall, that the Arab oil embargo of 1973 was the impetus for the beginning of the greatest build-out in nuclear history. The French nuclear fleet, now the world's fourth largest, was built as a direct consequence to France's insecurity with regards to the importation of energy.
Of foreign oil, yeah.
The Japanese fleet, the third largest, was born of the same circumstance. It was stated in the Japanese Diet, their parliament, that uranium is the only fuel in the world that has sufficient energy density that Japan could, in one warehouse, store enough energy to power Japan Inc. for 5 years. The concept of energy security, geopolitical energy security, has returned to our consciousness after a 50-year absence. And the only material that gives us sufficient energy density that a nation that is insufficient in energy resources, which is most nations in the world, the only way that you deal with that is uranium. You cannot store that much coal. You can't store that much oil or liquefied natural gas. You sure can't store that much wind or that much sunshine. It's only uranium. Now, does this manifest itself in 2026? Probably not. I disgraced myself at a conference a couple of years ago talking about the fact that SMRs were the technology of the future. And a gentleman in the audience raised his hand and said, Mr. Rule, the future has been operated by the U.S. Navy for 25 years.
Exactly. Yeah. I mean, that's what a submarine is.
But the truth is
that
it's going to be driven by all kinds of technology.
Rick Rule's message begins with humility, but also with a warning. He says when it comes to certain macro calls, he may defer to someone like Mr. Curry because Curry has spent a long time studying markets at Goldman Sachs, while Rick calls himself a rockhound. But don't let that humility fool you. Rick may not claim to be the polished pundit in the room, but when he starts talking about natural resources, energy, copper, uranium, and how real commodities behave, this is exactly where his experience becomes dangerous for anyone who thinks markets are only about headlines. The first big idea he gives is simple. The cure for high prices is high prices. That phrase sounds like a market cliche, but it is one of the most powerful laws in commodities. When oil gets expensive, people use less of it. When copper gets expensive, companies search harder for substitutes or delay consumption. When uranium gets expensive, utilities panic quietly and sign contracts. High prices create supply response, but they also destroy demand. That is why commodity markets are never just about one side of the equation. Price changes behavior. And Rick's example of oil makes the point perfectly. In the United States, if gasoline prices rise in a place like Reno, people complain. They curse at the pump, blame politicians, maybe threaten to buy a bicycle, then start the car and drive anyway. In wealthy economies, high fuel prices hurt, but most people keep consuming. Maybe they reduce one unnecessary trip. Maybe they stop buying the expensive coffee for a week, but life continues. The car still starts, the commute still happens, but in a poorer country, the same price increase has a very different effect. Rick gives the example of Colombo, Sri Lanka. If gasoline prices rise there, the taxi driver may not curse and continue driving. He may park the cab. That is not mild demand reduction. That is demand destruction. The customer disappears. The income disappears. The economic activity stops. This is why oil prices cannot be analyzed only from a Western consumer perspective. For one person, high gasoline prices mean irritation. For another person, they mean unemployment. That is why Rick says high oil prices obliterate demand in markets that cannot afford it. This is a crucial point for viewers because many investors assume demand is fixed. They think the world needs oil, so demand will always be there. But demand in economics is not just need. Demand is need plus ability to pay. Everyone may need energy, but not everyone can afford energy at any price. The marginal buyer sets the price, and if the marginal buyer is forced to boycott energy, prices can fall. This is exactly how high prices cure high prices. Oil rises because supply is tight or risk is high. Then poorer consumers reduce demand first. Then weaker businesses reduce demand. Then marginal economies slow. Eventually, the market discovers that the high price itself has damaged consumption. And once that happens, oil can fall not because the world suddenly became abundant, but because the world became too poor at the margin to buy as much as before. This is a harsh truth, but resource investors must understand it. Commodity markets are physical. They are not just lines on a screen. When the price changes, someone somewhere changes behavior. A refinery pays more. A trucker charges more. A family cancels travel. A farmer uses less fuel. A factory slows production. A taxi driver parks his cab. That is how price moves through real life. Now, Rick then shifts to an investment lesson that is extremely important. If you want to build an investment theme around a commodity, pick a big market. That may sound obvious, but many investors make the opposite mistake. They fall in love with tiny, obscure commodities because the supply-demand story looks exciting. Titanium, vanadium, rare specialty minerals. These markets can produce spectacular gains if you're on the right side of the boom. But they can also destroy you if one new deposit or one technological change suddenly increases supply. Small markets are fragile. One large new mine can change the entire balance. One substitution can destroy demand. One processing breakthrough can unlock supply. One government policy can flood the market. In a tiny commodity, a single project can matter too much. That is why Rick says you can make a lot of money on the right side of a small commodity boom, but you can also get your backside kicked when supply suddenly responds or technology changes the game.
We're in a risk-off environment. Gold is down. The gold stocks are down. A higher U.S. interest rate leads to a higher U.S. dollar. Gold is denominated in dollars. So it wouldn't surprise me, given that you need to consider both the numerator and the denominator, that the gold price falters in the face of higher interest rates. Make no mistake, we can't afford real interest rates.
What is Rick Rule doing right now in terms of investments in the precious metals industry? Are you just holding what you got? Are you nibbling on stuff?
But I'm changing the risk. I'm doing the opposite of what I told your listeners to do a year ago. And I'm deploying new money in the riskiest part of the sector, that the cure for high prices is high prices. Well, I've noticed that whenever I do something that's immediately unpopular, I'm invariably right. When you see a hyperbolic chart, that chart almost always resolves.
Sure. Vertical moves don't end by going sideways.
Yeah. The Canadians call that a hockey stick chart. The backside of a hockey stick is just as steep as the front side, but it's a lot less fun if you're long. I'm not a trader, but when I see a hyperbolic chart up or down, I bet against it. I just can't help myself. In this case, I had fundamentals on my side. I'm not sure that the low is in for precious metals. I suspect that nominal interest rates will continue until this administration loses its courage and forces them down. And a higher U.S. interest rate leads to a higher U.S. dollar. Gold is denominated in dollars. So it wouldn't surprise me, given that you need to consider both the numerator and the denominator, that the gold price falters in the face of higher interest rates. Make no mistake, we can't afford real interest rates. The interest on the U.S. debt and the fact that higher interest rates, if they continue higher, will decimate the long bond market when the U.S. government needs to refinance, and ultimately equity markets and consumer durable markets and the housing market means that eventually, like 1975, the political class and the voters will lose their nerve, and they will sacrifice the sanctity of the U.S. dollar to domestic politics. When that happens, like at the end of 1975, gold will be a beneficiary. Will that occur in 2026? I have no earthly idea. Will it occur? Absolutely. I'm a saver in gold. And I save whenever I have a liquidity event. I'll make a fair bit of money on this conference, and I'll put some of it in gold. That's just what I do. I save systematically in gold, and I'm fairly price insensitive. On the gold stocks, I'm starting to take more risk. We're in a risk-off environment. Gold is down. The gold stocks are down. The ones that are down the most are the ones that are perceived as being risky. At the same time that after 2.5 years of increased exploration spend, I'm starting to see some great exploration results. Mm-hmm. So I see some drill holes that give me spectacular data. And while the market moves, it doesn't move anywhere near the way it used to move. So I'm increasing rather dramatically my risk appetite. I'm not increasing the amount of money I have exposed too much, albeit I have a lot exposed, but I'm changing the risk. I'm doing the opposite of what I told your listeners to do a year ago when I said emphasize the biggest and the best. I personally...
So you're lightening up on the majors and putting more...
I'm not lightening up on the majors. Right now, I'm making a fair bit of money, and I'm deploying new money, in the riskiest part of the sector.
Okay.
We need to accelerate investment. The United States has a temporary surplus of natural gas produced as a byproduct of oil.
Now, the deeper part of Rick Rule's message is that the resource world is not just about which commodity has the best story. It is about which commodity has the biggest, most durable, hardest to fix problem. That is why he keeps coming back to big markets. In small commodities, one new mine can change everything. One technology shift can destroy the shortage. One substitute can crush demand. But in copper, oil, natural gas, and uranium, the problems are too large to be solved by one discovery or one press release. This is one of the most important lessons for investors. A small commodity can give you a spectacular boom, but it can also punish you brutally. If the market is tiny and supply is tight, prices can explode. But if one big deposit comes online or one new technology unlocks supply, that same market can collapse. It is like a small room with too many people inside. If one door opens, everyone rushes out at once. That is why Rick says you can make a lot of money in a small commodity boom, but you can also get your backside kicked when supply suddenly appears. For serious long-term themes, he wants scale. He wants markets where demand is enormous, where supply response is slow, and where the world cannot easily substitute away. This is why copper matters. This is why uranium matters. This is why energy matters. These are not small side stories. These are the physical foundations of the modern world. You cannot run artificial intelligence without electricity. You cannot expand the grid without copper. You cannot build reliable, low-carbon baseload power without nuclear being part of the conversation. And you cannot pretend the world's poorer consumers will keep buying energy at any price. The oil discussion is a perfect example of how Rick thinks. He is not simply saying oil goes up because supply is tight. He is saying high oil prices change behavior. In wealthy countries, high gasoline prices are painful but manageable. People complain, but they keep driving. They may grumble at the pump, blame politicians, and then drive to the grocery store anyway. But in poorer countries, the response is much more severe. The taxi driver in Sri Lanka does not just complain, he parks the cab. That is demand destruction. This difference matters because the marginal buyer sets the price. The marginal buyer is not always the wealthy American commuter. It may be a consumer or business in an emerging market that simply cannot afford higher prices. When that buyer disappears, the global price can weaken. This is why oil can correct after a spike even when the long-term supply picture is still tight. The high price itself breaks demand. That is the cure for high prices. But the opposite is also true. The cure for low prices is low prices. If oil falls too far, companies stop drilling, investment falls, Future supply gets damaged. Then years later, the market wakes up and realizes it has underinvested. Prices rise again. Commodities are cyclical because human beings are emotional and capital is always late. When prices are high, everyone wants to invest. When prices are low, nobody wants to invest. But the best time to build future supply is usually when nobody wants to pay for it. That is why Rick is constantly looking several years ahead. He is asking not just what oil costs today, but what today's price does to future supply. He is asking not just whether copper is strong today, but whether the world can build enough copper mines to support AI, electrification, and demographic growth. He is asking not just whether uranium has rallied, but whether the world has enough nuclear fuel to support the return of energy security. That is the mindset of a resource investor. Now, copper may be one of the clearest examples of a big market with a big problem. If AI grows, if data centers expand, if electricity demand rises, if grids are upgraded, if developing countries continue urbanizing, copper demand increases. The digital world may look invisible, but it rests on physical infrastructure. Every server farm, every transmission line, every transformer, every electric motor, every new grid upgrade needs copper. AI may live in the cloud, but the cloud has a very real electricity bill, and that electricity bill is going to be enormous. Data centers do not run on slogans. They need uninterrupted power, cooling systems, transformers, switchgear, and grid connections. Copper sits quietly inside all of that. It is not as glamorous as AI chips, but without it, the system does not work. In that sense, copper is one of the hidden picks and shovels assets behind the AI story. People chase the software. Rick looks at the metal that makes the software physically possible. The supply side is the real issue. Copper mines cannot be created quickly. Discovery takes time. Permitting takes time. Construction takes time. Communities object. Governments intervene. Ore grades decline. Costs rise. Environmental standards become stricter. A new copper mine can take more than a decade from discovery to production. So when demand increases, supply cannot simply appear because the price went up last Tuesday. That is why Rick says there is nothing we can do to alter copper supply in a reasonable time frame. Price can go up, investors can get excited, politicians can talk about critical minerals, but copper still has to be found, permitted, financed, mined, processed, and transported. The world can print money quickly. It cannot print copper. That difference is where the investment opportunity comes from. Of course, Rick adds an important warning. Copper is tied to the economy. If there is a depression, copper gets hurt. A depression reduces construction, manufacturing, infrastructure spending, and industrial demand. So if a viewer believes a major depression is coming, copper may not be the place to hide before that depression occurs. But if the world muddles through, even with stress, and especially if AI infrastructure keeps expanding, copper becomes a no-brainer in Rick's framework. That phrase, muddle through, is important. Copper does not need a perfect world. It needs a world that keeps building. It needs power grids, cities, data centers, factories, transportation, and electrification. If the global economy avoids a deep collapse and continues modernizing, copper demand remains strong. The supply response remains slow. That is a classic resource setup. But uranium may be even more strategically important. Rick says in many discussions, the answer has to be uranium. And the reason is not only price, it is power. AI needs enormous amounts of reliable electricity, not occasional electricity, not electricity when weather conditions are favorable, not electricity that depends on whether the wind is blowing or the sun is shining. AI needs 24/7 power. Data centers need constant power. Modern industrial economies need reliable baseload energy.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.